Okay, so investment function. So what do you mean by investment function? What are the determinants which affect the investment? What are the factors which can increase or reduce the investment? This is what we're going to learn in this video. So let's see. So I want to remind you of the consumption function, which I explained in the previous video. So I said, so consumption equal A plus B, Y. And when I explained the consumption function, I said, so the income is the key determinant of consumption. Now let's look here on the second component of GDP, which is investment. So we have a little bit similar function here. So I stands for investment, and A is a constant, and D is the slope, and this is R stands for what? So this is the interest rate. So here we say that income is the key determinant of consumption, and interest rate is the key determinant of investment. So, and this is, you have to understand that this is the real interest rate, which equals the nominal interest rate minus inflation. Okay, so this means, let's explain this on the XY axis. So this means interest rate, this is the independent variable. So this is going to be on the Y axis. And investment here is the dependent variable. So this will be your X axis. So that's why we put investment here on the, sorry again. So this is the Y axis because this is the dependent, and interest rate will be your independent. So it's going to be the X axis. So here the interest rate on the X axis and investment on the Y axis. So for instance, if interest rate is 5%, and I want to invest my money so I can get loans at a less rate. So this means I will have more incentive to invest. So this will be my level of investment. If the federal bank increase the interest rate, so now it becomes 10%. So this means this will be additional cost for me. So I will have less incentive to invest. So that's why I will invest less in this case, and so on. If my interest becomes 15%, this is too high. So this means, so I would have less and less motive to invest. So as you can see, if we connect these points, so this is what we call investment function. And as you can see, this is negative because it's a negatively sloped. So why is negatively sloped? Because whenever interest rate is low, so we should expect that investment will be high. So there is a negative relation between interest and investment. Okay, so let's see a question. So let's see this question. So here the expected rate, which is okay. So here we have, this is the interest, and here we have investment. Okay, so with 18%, this is too high. So this means I will not have any incentive to invest at all. With 16%, your investment will be 10%, and so on. So let's answer these questions. If the real interest rate in the economy was 18%, so business firms would plan to spend, the answer will be 0 here. But if the real interest rate is 16%, they would plan to spend how much? They would plan to spend 10 for investment. Okay, number B. Should the real interest rate be 14%? This is 14%. And they would still wish to make the investment that they were willing to make at real interest rate of 18 and 16. They would plan to spend an additional $20 billion, and their total investment would be, so here's the trick. So the investment is calculated by adding all the previous investment. So you have to add 0 plus 10 plus 20, which is equal 30. Let's have another example. So if real interest rate equals 12, they would make all the investment they had planned to make at a higher interest rate plus an additional 30, and their total investment spending would be 60. So 0 plus 10 plus 20 plus 30. So this gives you 60. Okay, so this is the investment project under each interest, but here this is the final table. This is the amount of investment. So in this question, I'm asking you to complete this table. So simply, so like how did I get 10? So 0 plus, okay, so 0 plus 10 equals 10 here. Okay, how did I get 30? So 0 plus 10 plus 20, this gives you 30. How did I get 60? So 0 plus 10 plus 20 plus 30, this equals 60, and so on. So what about the 10%? Okay, so the 10% here, so should add all of this. 0 plus 10 is 10, plus 20, 30. Okay, 60, 40, and this is 100. And then this is 150. $210, and then this is 280. Okay, so this table is a table of what? Of investment. So here, this is the table of investment curve. Okay, so the relation between the real interest rate and the amount of investment spending is negative. So the relation is negative. That means when the real interest rate increases, investment will decrease. Okay. So far we saw that the most important factor which affect investment is the interest rate. Now, is there any other factors which can affect the investment? Yes, and these are the factors. Expectations about economic and political conditions, technological change, capacity utilization, and business taxes. So let's see a question on this. You are supposed to indicate the impact of each of these events on investment. So if stock market prices increase, this will increase your investment because you are making money, you are selling the stocks at a higher price, so this will motivate you to invest more. Okay, and these are the answers for the other questions. Okay, so this concludes my video, and thank you so much. Bye-bye. Actually, let's continue this question. So here, development of expectations by business executives that business taxes will be higher. So increase in taxes. So this, of course, will lower investment. Step up in the rates at which new products and new production processes are being introduced. This will motivate you to invest more. Business believe that wage will be lower. So from your perspective as a business owner, so this means you less expenses, so more investment. Expectation of a recession, of course, less investment. Believe that business is too good and the economy is due for a period of slow. So this means you are expecting that there will be a coming recession, so invest less investment. Rising cost in the construction industry, negative rapid increase in the size of the economy population, positive, and recent period of high level of investment spending, which result in productive capacity in excess of the demand, so their impact is negative. So that's it. This is what I have for this video. Thank you so much.